Hi, my name is El, and today I'll be showing you how to use this loan amortization calculator. So this is a calculator that you use to determine or to calculate how much you are required to pay on a regular basis in order to service a credit agreement. Alright, so it will calculate the installment that you are required to pay and then the term or how long you are actually going to service that credit agreement. Alright, so I'll explain it from top to bottom so that you understand it completely and how to use it. It's not difficult. Alright, so the first part here is the lender name. That's just to identify what loan it is or credit agreement it is. So the lender name is the credit provider who's extending the debt to you. Okay, and then the credit type would be the kind of credit agreement it is. It could be a personal loan, it could be a credit card, an auto loan, or a vehicle loan, or a mortgage, or a student loan. So you just put in the credit type here, and then the account reference would be the account ID or account number, which is basically a unique identifier for that credit agreement. So when you make payment towards the account, the credit provider knows which account to credit, which credit agreement to credit. Okay, and then when we then go to this part here, this enter values section. So this is where you are going to enter the numerals or the actual figures that are required to then calculate the information that you need. Okay, so you have the labels here: loan amount, annual interest rate, loan period in years, number of payments per year, payment start date. So you can rename this, but it has to be close to this. It just has to be other phrases and other words for the same things that are written here so that the calculator can still do its job properly. Right, so we have the loan amount. This is the capital or the balance that you've been given by the creditor. Okay, so let's say, for example, in this scenario, it's 120,000 that you have been given, and then the annual interest rate. So you will be given the interest rate by the credit provider. They will tell you what the interest rate is, and then so you put in the rate. It's always calculated per year. Okay, so you put the annual rate here, and then the loan period in years. Then this is how long you are required to service the debt, but in years. So if it's 5 years, then you put 5 years. If it's 4 years, you put 4 years. If it's 2 years, you put 2 years. Okay, so I'll just put 5 years because of the balance here. So 5, and then the number of payments per year. So this is the number of scheduled payments that you're required to pay per year. Okay, so we assume for a standard credit agreement you're required to make 12 payments per year, which is a payment every single month of the year. So that's why you put 12 here. But if it's a special type of credit agreement where maybe you're required to make payments once every quarter in the year, then you are going to put 4 here. So if you put 4, the calculations change. Okay, but if say also, for example, you are required to make a payment once every 2 months, then that means that you are making 6 payments in the year. So you put 6 here. All right, but for the sake of this calculation, I'm going to go back to 12, and then you have your payment start date. This is when you are required to start making payment by the credit provider. Okay, so let's say you are required to start making payment on the 15th of June. So you just put the payment start date here, which is 15 June. And then what the calculator does is then that your first payment will be marked as the 1st of June, right? The 15th of June. Why am I saying the first? The first payment will be the 15th of June, and then it adds everything up as you go along. It increments as you go along. So payment will be on the 15th of every single month, starting from the 15th of June, since you specify that as your first payment date. Okay, and then you have the return values side. So as the term implies, this information is actually returned by formulas that are embedded within this calculator. So these are the results of the information that you've put here. So the scheduled payment, this is your minimum payment, or the amount that is required to service this debt of 120,000 at an interest rate of 8%, which is supposed to be paid over 5 years, which is getting 12 payments per year. Okay, so you are required to pay 2,433.17. Okay, and then it also translates the actual term into months or number of payments. So it's telling you that you're going to make 60 payments. That is 2,433.17 by 60. Okay, and then you have the total principal payments. This is just the loan amount. The principal payment is like giving the credit provider back their money. So the principal payment will always be equivalent to the loan amount. And then the interest would then be $25,990.04. Okay, so the interest is the cost of borrowing, which is based on this. So it's going to calculate all the interest charges for these 60 payments, the interest that is being charged over this period, and then it will sum it up and give you that here. And then you have the total payments, so that is your principal payments plus the interest. This is how much you're going to pay in total, $145,990.04. That's the total. So you took this amount, and for this amount, based on these figures here, you're going to give the credit provider back this much. Okay, right? So the amortization schedule then gives you a breakdown of every single thing. So you have the payment number, the payment date, it is the opening balance, the scheduled payment, the principal payment. So what it does is that from the scheduled payment, it tells you how much is going towards the principal, right? That is the loan balance. And then it also tells you how much is going towards the interest charge. Okay, and then you have the end balance, and then on the cumulative interest, this is just the interest that is being added every single month. So it is telling you that this is how much you've paid so far. So in the first payment, you are paying 800 in interest, right? And then in the second month, you're paying 789.11 in interest. So in the second month, at the end of the second month or the second payment, you have paid a total of 1,589. So it's just an addition of these two here, right? So in the third month, you have paid interest of 2,367.26. So it's an addition of all these. So it sums it all up as you go along, so that at the end of it all, it will give you, this is how much you have paid in interest. Okay. And then what this calculator does also is that as long as there are figures here, based on whatever it is that you put here, the term is going to be populated, and it's going to generate the full payment schedule down here. Okay, so it can accommodate up to 480 payments. So if you're paying, let's say for example, a mortgage over a period of 40 years, let me just give that as an example of 40 years, over a period of 40 years, and you're making 12 payments per year, it is still going to accommodate that. So here you see it calculates, or it's reflecting up to 60 months, because that is when this credit agreement is paid up. Okay, so whenever the credit agreement is paid up, it's going to cut off the calculations. You won't see anything below that. So but let's say, maybe let me change this to 10 years here. So you see that your installment is now lower because you are paying this over an extended period of time. Your installment is now lower, the interest, and you see. But I just wanted to show you the amortization schedule and how it looks. So we are past, you can see here, we are past the 60th payment. So it's going to keep going down until it gets to 120, and then it cuts off. That's what it does. So don't be alarmed when you put in figures and then you start thinking maybe you don't be able to accommodate a credit agreement with more terms. So this is how how it works. So you will not be able to edit this part here because there are formulas there, and if you make any mistakes, then that means it may affect the figures that you see. It's just to maintain the accuracy of the calculator. Okay, so you won't be able to edit, but you will be able to edit this part and then rename everything here. But this part here, these figures, you cannot edit them. You can edit the labels, but you cannot edit the figures. Okay, so that is it. That is the calculator that I have for you here. And if you're interested in more Excel tools, actually I forgot to mention, for now this is only available in Microsoft Excel. We don't have a Google Sheets version. So if you are interested in similar templates, please just leave me a comment. We actually have one that we have at the moment which accommodates up to 20 credit agreements, but that one calculates for you the term based on the loan amount, interest, and the in the payment. So you put the you put the loan balance, and then you put the annual interest rate, and then you also stipulate the payment that you are paying every month. And then it calculates for you the repayment term, and then it gives you also the total principal, the total interest rate, and the total payment. So it's going to calculate this for all 20 credit agreements. It accommodates up to 20 credit agreements. So you can, if you have 5, then you just put 5, and then it's going to calculate that for you. So yes, you can look out for a video for that calculator. Well, I may actually link it to this video. Okay, so that is all from my side. Please leave a like if you like the video, and leave a comment if there's any information that you want to share, if you have a query or if you have a suggestion, and also subscribe so that my video gets pushed to a lot of people out there, and then you also get notified whenever I drop something.